What's up, everyone? Welcome back to the Outlier podcast. I have a familiar face, Tom Basso, coming to hang out again. First off, happy birthday.
Hey, it was a good day. I fixed an irrigation leak in the backyard that I was plagued by that I couldn't figure out, and I finally found the leak and got to it and repaired the header, and everything's working beautifully now. So
I love
very
that.
happy day.
I find a big part of home ownership is irrigation maintenance because I literally have two little like hand carts, one upstairs, one downstairs, literally for fixing irrigation, which I do all the time. So it sounds like it's a mutual experience because I forgot you're up in the mountains. So
I am now, yeah.
yeah.
I got two houses. We go down to the valley in the Scottsdale area, North Scottsdale, for the winter usually. But I'm going down this afternoon because I'm meeting up with some family who are coming in from the airport. So I get to go out to dinner with everyone tonight.
That's so awesome. I'm stoked. Well, you're looking great. You're probably healthier than I am right now. I was telling you I got a herniated disc, so your boy is
I had a bulging disc that blew
good.
when I was let's see, when I would have been about 50 years old. It finally ruptured, and oh my gosh, bad pain.
Yeah. And
I got
then
a, but unfortunately, I got one of those fancy shots with the very long needles. And surprisingly, 15 minutes later after the shot, I walked out completely normal, and I haven't had any problems since.
well, maybe
So,
I need to find that shot because mine's been going on for like 2 weeks and it's not been super fun. So
yeah,
I'll have to look into it. But
yeah.
enough about my broken back. Let's talk about some markets. So I figured a good place to start actually is with the recent sell-off that we had. What do you make of that? We saw it kind of across the indices, and yeah, what are your thoughts there?
Yeah, I just think it's we had a long time of a lot of up move, a lot of concentration of the money into things like Nvidia. And I think what ended up happening is everybody was sitting there, having made some nice money and getting a little itchy to take those profits. And I think when the thing started falling in for any excuse, it was like a match on a bunch of gasoline. It just, poof, all of a sudden you had a firestorm. And then now the last week or so, it's been trying to climb its way back out of the hole. But boy, today was one of the quietest days I've ever seen. I gave up and went and fixed irrigation. It was a lot more interesting. And I tied down some netting in the vegetable garden and did some pruning and had a nice day outside, took a shower, put on the uniform for the interview. And yeah, it's been a nice relaxing day, but there was no point for me to be at my desk for sure.
Yeah, one of the things that I thought was interesting, to your point, I felt very similar with the sell-off. It felt like we had a very just one-sided move. It's hard to classify like what overdone is, but it just seemed like we were going up. And to me, when the market does that for long enough, to your point, I always get the sense that you kind of never know what's going to tilt it, but something typically does. What I thought was interesting, though, was the series of gap downs into kind of that really strong support day on the 5th, where, I mean, it had a pretty nasty previous 2 days.
Mhm.
So when you see the market take a bite on a day like the 5th, what do you make of that? Do you think that's kind of just where the market is deciding this is a value area? I like it here, sell-off's enough, or what do you think?
Well, what I think actually is a supply and demand of orders with a lot of computer power behind it
Hmm.
means that things are going to move very fast, and a lot of people are going to adjust their positions very, very quickly.
Hmm.
And because of the speed they can do that, I don't know that the support area, to me at least, would be magical at all. I think it's just that everybody that wanted to take a profit or sell or get nervous or do whatever they wanted to do had done it. So the selling kind of subsides a little bit, and then everybody starts looking at everybody and deciding, do I want to be the hero that steps in and starts making it go up again? And judging from the last week, they haven't been really excited about that. They've been really, it's been very quiet and making new highs every day, but it's not very much of a new high, and the bars are getting skinny.
Yeah, that it's funny. I was actually gonna, that was my next question, is I noticed for the first 3 to 4 days of kind of that, I don't want to call it a V because it's not yet, kind of like a
No?
L. But the
Yeah.
first 3 or 4 days were, I thought kind of moving up, I thought semi quickly, but then it seemed to really start slow down. And it sounds like from your opinion, it's been mostly slow across the board. So
Right.
what do you think of the buying behavior that you saw over the first few days compared to what it looks like now?
I would say the buying behavior hasn't been really strong in that, boy, the selling was pretty definitely panic mode. And so if this thing touches off again, you could have another leg down and you could be into a full-fledged bear market. And a lot of the traders that got their stimulus checks back in 2000 when we had COVID and all that have been trading largely an up market. They have not seen a major bear like down 50%. It could get ugly and could get ugly quickly, and it could be take a real bite out of a lot of people's portfolios if they aren't careful. The answer is just to simply think about what you're doing and have a plan. On long positions, I can hedge stuff, I can time out of things, I can go short on some of my strategies. Uh, I'm not at all worried about a market sell-off. It could be actually profitable, but
Yep.
to not have a plan is to fail. And
Yeah. Yeah.
I
Completely
hate to
agree.
see that. What'll end up happening is, I have a big presence on Twitter and everything, and people DM me all the time. And unfortunately, a month or two into the next bear market, whenever it occurs, and if I'm still alive, um, I'll get these DMs that'll say something about Mr. Basso. Um, I I am a long only trader in stocks, and I noticed that you went to a down direction and hedged your portfolio, but I didn't do that, and now I'm down 25%, and I'm wondering if you could advise me on what I should do now.
Hmm.
I get those all the
Love
time.
that question for
I,
you. What's the response? What do you say to that?
I usually start with, I don't know what to say. I kind of have been warning people over and over again to have a plan. You didn't develop a plan. I also talked about hedging your portfolio. You didn't hedge it. Now that the cat has left the building and is wandering around the neighborhood, you want to know what you should do to keep your cat in. I don't know what to tell you. Develop a plan and execute it.
Get it right the next time. Yeah, those.
Yeah, it's too late now. I mean, and I get those all the time, right in the middle of big bear markets or bear
Yeah.
moves. The COVID crash, for instance, everybody was panicking, so thoroughly panicking. And when they did that, they ended up getting to the point where they were they were really losing a ton of money, and they ended up asking me what to do, and I'm thinking, all right, let's see. You could start looking at whether or not you want to buy or whatever, get ready for the next cycle the other way. It's a little early to do that because you're in the middle of the downswing, but it's crazy. People just don't think ahead. They'll have one way of thinking, one strategy, and and their 10 favorite stocks or something. And there's a whole world. I mean, there's thousands of positions out there that you could diversify into. I'm trading 35 futures markets now. I'm trading multiple indicators, multiple time periods. So, I look at a screen any one day, I've got red and green on the screen. I just hope that the green is a little more than the red. You just can't do one thing one way. If you're going to do that, you're going to have to expect some severe drawdowns with no place to hide. You just
Right.
can't avoid it.
Yeah. Seems to be part of the game. Now, exploring that scenario a little further, let's pretend that that person DM'd you before the market dropped. And let's say it's a similar scenario though. Let's say that they're still long only, which to me is it's kind of a big crutch because you miss a lot of different things you can do. But keeping that same level set, long only. When you're talking to them about creating a plan, what kind of things would you tell them to take a look at with that plan?
The first thing I'd always ask is, do you have stop losses on your positions? If you're buy and hold and you have no idea where you're going to get out of anything, you don't have a complete trading plan. I think you should have an entry, you should have an exit, trailing stop of some sort. If you have profit objectives and you're trying to limit your gains, not a big fan of that, but there's some strategies where it makes some sense, I suppose. And if you're going to have that, put the limit order in there and take your profit on part of your position or whatever you want to do. But have a total plan. So it's the plan to get in, the plan to get out, plan for your initial stop, any kind of trailing stop, and any kind of method of taking profit if there is going to be one. Then on top of that, you got to have a plan for how to size your position. Number two, and that sometimes is more important than I think the first things we talked about, all the buying and selling. Because if you size something too much, you're putting yourself in harm's way. If you size yourself too small, you might have a great return, but it won't affect your portfolio positively enough for you to make the money that you needed to make on that one to pay for the losers that are no doubt going to be there too. So you got to be in balance all the time, and position sizing is so important with that. Then the last thing is, if you're going to be long only, can you try to stretch your portfolio out somehow? Example, you could be long only in stocks, but you could then also look at being long only in corn. And corn and stocks don't have anything to do with each other, so they're going to go up and down at different times. And I'll add to that things like gold, things like industrial metals, things like energy contracts, things like meats, things like softs like cocoa and orange juice. Cocoa's had a really good year. You could have a tough time in stocks, and sometimes there's some days where the cocoa position was pretty much providing the profits for the day just off of that one position. It was just having that big of a move. Orange juice last year the same way. They may seem like wacko markets to trade, but they move. They go up and down just like anything. Crypto's futures. You don't have to trade just in crypto if you don't trust the wallets and all that nonsense. And in the futures, you can go long and short just as easily as anything. So I trade the Bitcoin futures and the Ether futures, and they move. When they move a lot, you make a lot of money. It's
Yeah.
but they can be doing that at a completely different time when say the NASDAQ is having a rough day or the Russell's having a bad day. All of a sudden the crypto futures are having a good day. So you just don't know. Or you could be short the crypto futures and the whole thing's caving in and the NASDAQ's down and the cryptos are down, and so you're losing money over there, but you're making money on the other side. There's lots of different return streams you can examine out there. And when you start blending them all together, all you do is smooth out your equity curve.
Right. So a lot of it building either inversely correlated, moderately inversely correlated, or more so to your point, non-correlated returns, things.
Non-correlated. Non-correlated is always the best.
Yeah.
Inversely correlated, if you're attacking risk of a very specific nature, like hedging a stock portfolio. So you're long only on stocks, you're short on a futures contract of, say, the Standard & Poor's 500 or something. Those two are an intentional inverse correlation item, and you're trying to knock down the risk of the long portfolio. In the case of just trading diversified contracts, and if you want to be long only, you can do that. Or if you want to, in some cases, you can go short just as easily as you can go long in the futures markets. So I like that aspect of it. And yeah, you can get so many different return streams. It's just, I can't even keep track of which way I'm leaning on most markets unless I look at the screen. 35 is getting beyond my 72-year-old brain to absorb all those tickers and realize which way I am. So thank goodness for computers and spreadsheets
Yeah.
and
So when you're, especially in your scenario, 35 markets, you have to size thoughtfully because the volatility of those markets will be different and those kind of capital value at risk will be different. So going back to our DM, this person reaches out, you give them those 3 pieces of general advice. And if they have a follow-up question, something like, do you have any general guidance on sizing positions? What would that look like?
sizing positions is a little bit of a function of the size of your account,
Mhm.
your risk tolerance, I would say, and how well you've designed your trading strategies to, in some cases, intentionally diversify or oppose each other. For an example, I have a long-term future strategy with those 35 markets where I could be in a Japanese yen trade for a year and a half. Okay. But then there's going to be times when the Japanese yen goes down, let's say, and I have the potential to pick up a shorter term profit. So I have a counter trend trading strategy that's on the order of days that would quickly reverse. And I've sized them so that the counter trend strategy is roughly twice the size of the long term strategy. And the reason for twice is very quickly as it pops off of an overbought, oversold condition, I take half of that profit off the table and it pays for the trade. So this is an attempt to get my reliability up to 50% or more. And I'm not looking to get rich off those counter trend trades. I'm just looking to buffer what I know will be a drastic pullback in a long-term strategy from a peak or a trough as it gets back all the way to its stop loss, which because it's a long-term strategy is going to be fairly far away.
I
So I
see.
have all these different things going on, but those 2 strategies are going to tend to completely fight each other during certain periods of time and essentially take my net position down to near to zero,
Right.
roughly.
Now,
So,
you
but that's by design. Notice I designed it that way. So if you're careful about doing stuff like that, then you can up your amount of position sizing because you know that you're protected from that drastic drawdown that would happen if you didn't have that second counter trend strategy in there. You know that long-term strategy is really going to hit you hard if you
right.
size it too much. The long-term strategies I run in my own case, it's a retirement portfolio and I'm pretty seasoned. I can handle some risk, but I don't like to take on a huge amount. I run my positions at a half of 1% of equity.
Got it.
So I would take, say, a corn contract. I'd calculate where the stop was. I would calculate the value in dollars per bushel of, or cents per bushel of how far that stop is. And then I would equate that to my equity and figure out how many contracts do I need
Right.
to get to a half of 1%. It's
Got
really
it. Yeah.
simple.
Which immediately answers the second question, actually, funny enough, which was thinking about the stop losses, which I think the way that you're doing it there for people, it simplifies it exactly to your point quite a lot. Because some people, they go back and forth on if they should size something based on, the cost of the position relative to the value of the portfolio. But in your scenario, kind of you're highlighting a giant gap with that. Whereas what's the risk on that as a value of the portfolio if you're putting it on based on overall portfolio size?
Yeah,
So,
sizing on dollars has also the problem of, if you think about it, let's say you got a NVIDIA in your portfolio and you have some utility stock. They're different prices
right,
drastically. They're very different in the speed that they move and the percentages that they move per position each day. So one might be going up and down a percent a day, and the other one's going up a tenth of 1% a day. If you got the same size of both of those positions, then the second one, which is going up a tenth of a percent a day, is not really contributing a heck of a lot mathematically. So you kind of start realizing, well, I'm just trading this one stock and I've got a few other hit and misses in my portfolio, but it's, you're not getting a diversified portfolio. Are you getting one thing, one name, and then a collection of other garbage that really doesn't make much difference? That's
right.
not, to run a portfolio, in my opinion.
Yeah, just kind of noise.
So I
When
always do this. I always make sure you use your price charts, use your techniques, use your Keltner bands and Bollinger bands and Donchian bands and whatever you use for your buy and sell. Set your stops first per one share. That's the easy way to do it, right? Now that you know one share, or in the case of futures, one contract, same way, then do your calculation, say, okay, what would be a half of 1% of my current equity? And I use today's equity. I don't screw around with realized equity and unrealized. It just makes it more complicated and you get roughly the same answer. It's not worth the trouble. If you can just look at your equity, you can get that right off your trader screen usually. Multiply times a half of 1%. That's how much risk you can take in dollars. You know how many dollars there are per share? You do math that you learned in seventh grade, I believe. Divide it out and it tells you, I don't know, do 8.9 shares or 89 shares, and that's the number you do. It's
right.
easy.
Yeah, yeah. When you're looking at the positions that you're building in futures and you have a longer term position, shorter term position, what time frames are you using for those?
I don't build positions typically because a study I did once showed that the initial trend following signal is always your best return to risk, and I'm a big return to risk
Okay.
fan. So I really don't want to build additional positions on. Are there trades where it would make sense and that you possibly could even find some low risk add-ons where you could build a bigger position? Yeah, there probably are, but on average, when I did the studies, it diminished the return to risk over time until you get to the day that you actually sell out of the thing, then the trade's over. So I don't build other positions, but what was your point you were asking then?
I
How
was
do you,
curious about the time frames that you use for the longer term positions, and
okay,
then
well,
I
the
know the
time
shorter term you
frames,
said it's just a few days.
time frames, I would say long term would be anything, say 3 weeks or beyond,
Okay.
roughly. So something like 21 days or beyond, something like that. 21 trading days is roughly a month. You're starting to get into pretty long-term periods there. Counter trend trading, I'd be down in the 3 days or less.
Right.
So
Got
the
it.
two are in very different time frames. I think if you do that, you get a little bit of the action where if the markets are going sideways, you're going to get that short-term one kicking in and out and trying to whipsaw a little bit, but hopefully taking small losses. Meanwhile, the long one is so long-term that it just sort of sits there and doesn't do anything. That'd be kind of what I'd try to be getting to.
Got it.
Design.
Yeah. And then two other questions off that. The first one is for that long position that's about 3 weeks out. Are you taking that into expiration and then rolling it back out? Or do you have a earlier roll period to maintain that exposure?
I try to take each contract to the point where the new contract is trading at a larger volume and open interest
I
than the
see.
old
Okay.
one, and I just roll it.
Got
So
it.
in the case of a year and a half trade, depending on what you're talking about, I might, if it was like a crude oil contract and I happen to be in it that long, it'd be something like 15 or 18 rolls that I would
Okay.
do.
Got it. And then what's the way that you think about adding the counter term trade? Is that just kind of a consistent carry, or is it something that gets turned on when one of your signals says momentum slowing or whatever the case is, put on the
No,
counter?
I trade it every day. I just
Okay.
I look for an overbought, oversold condition. I use a let's see, what do I use? I use a daily data and I use a 21-day RSI stochastic.
Got it.
And I use 80 for overbought and 20 for oversold. So if I get an overbought condition and an up direction, my long term is probably clean and clock and making money. I'm then set up for a short sale in the counter trend. And what you'll find many times, or I find, is that even though I'm overbought, you can stay overbought and you can stay overbought and you can stay overbought. And day after
Mhm.
day, I just keep moving up the stop and I keep looking for my next counter trend trades with, as long as it doesn't want to come, I'm happy. The long-term position's just making money. On the day when it starts going the other way though, and you get a day like Monday,
Okay.
last week where the stocks were crashing, then all your counter trends are hitting in and you're just cleaning up. So
I see. And then when you're rotating this P&L on the shorter term counter trend trades, does that impact the way you think about your stop on the longer term trade, or are they completely disparate?
completely separate,
Got it.
designed to be separate, designed to counter oppose each other. But I trade each strategy distinctly according to
Got it.
the prices and the mechanisms and the timing and the time period and the parameters sets and all that that were the original design for. It's a very specific purpose.
Right,
Each
right.
strategy has its own sort of job in the crew. The crew comes together and does its thing and builds my portfolio every day, but each one has a job to do and they don't have to worry about what Joe over here is doing.
Right, right.
He's
Yeah.
got to pay attention to what he's doing. So
Makes total sense. Now, if you were thinking about the same portfolio structure, you were saying 35 names, obviously you're a seasoned pro and you're kind of like, that's about where I want to be. If you were talking to somebody that has, a little bit less experience or maybe not the bandwidth to monitor 35, what kind of number of positions do you think would make sense for just like a general guidance? Let's say it's somebody that's trying to, that DMer, they're trying to grow their account over the next 20
all right,
years.
well, I'll give you a couple answers. If you're starting out and you scratch together 5,000, you're really putting yourself in a tough spot. But hey, I started with 5,000 back when.
Oh, yeah,
And of
a
course,
lot of
the
us have.
5,000 I started with was worth a lot more than 5,000 is today. But 5,000 back in the day when I started probably is more like a 15 or 20 today. If you can get that together, you got a reasonable shot at now diversifying a little bit. I'd be shooting for probably about 10 positions.
Got it.
You, if you're just going to be in the stock market, you're going to get a lot of correlation amongst stocks. So do what you can to find different industries that you can put your positions in. Don't just all go out and put it all in tech names or something. You're going to take a much wilder ride if you do that. Then I'd also consider micro futures. There's some very small futures contracts that you could do 5 stocks and maybe 5 futures contracts and get a little blend going. That way you got better diversification. You're gaining your experience level on both sides. Keep trying to make money and keep trying to add to the portfolio, keep your capital growing. You get up into the, say,
Quick question on that.
100,000 area. And maybe at that point, I would see maybe 20 positions would be logical. Maybe 10 of them in futures and 10 of them in stocks, something like that. Spread it around a little bit. Then it's just more of the same as you get larger.
Got it. Quick question on the smaller portfolio, the idea of like 5 futures, give or take 5 individual names. What kind of futures would you focus on? Obviously, if you're trading the micros, you are heavily limited by finding things that are good and liquid. There's a handful of things that probably would fit that category, but I'm curious
Yeah.
which you'd be thinking about.
Well, I would look for the smallest possible contracts. So the micro ether is fairly small. So the crypto futures contract on the ether side, not the Bitcoin, that's bigger. But the ether is very small. The new lumber contract they just came out with is very small. You could probably find a micro soybean contract or corn contract that would be fairly small. British pound contract isn't massive. You could probably do that one. That would give you a start at least. Make sure if you do silver, make sure you do the 1,000 ounce, not the 5,000, which is 5 times larger. Sugar is not overly large. Micro or mini natural gas is not very large. Probably trade that one. Aussie dollar is not massive. You could probably look at that one. Those are some to start at least.
I think it's a great list. The reason why I ask those questions is a lot of people, they'll ask me about starting like an options portfolio with $5,000. And I always struggle with that one because it's like as soon as you place a single trade, you're missized. Like you already are in a bad spot. So
Yep.
I kind of asked you the hard question and made you do the heavy work there by coming up with a bunch of good names. So thank you for that.
Yeah, options are a hands-on problem for a lot of people. I guess if you're trading full-time, fine, but if you got a $5,000 portfolio, chances are you've got a job someplace, I suspect.
Yeah,
But when you're on options, you got the tricky problem of time premium and expiration and
volatility, great.
volatility
Yep.
of the market at that point in time and how emotional people are getting. So trying to get that reduced down into the actual underlying underpinning of your profits and losses is far more difficult. Futures to me seems simple compared to options trading.
Absolutely. Yeah,
So
they absolutely are. Yeah.
and I can put in stops and go out and fix irrigation or go play golf or whatever, and no problem. I'd come back in and do my afternoon work and my data run, and I find out what I got executed today.
Right. Yeah. It's one of the nastiest things I find about just the market in general and what expectations are. Because a lot of people, they find their way into options thinking that it's fast, easy, leveraged money.
Mhm.
And exactly to your point, it's why so many people just evaporate their money because it's essentially anything but that.
Yeah,
So,
I
yeah,
mean, if you're trying to get the lottery ticket and become a billionaire next
sure.
year, starting with 5,000, I mean, you're gonna have to take massive
Need
amounts
some
of risk.
leverage.
And yeah, okay, maybe the options are the way to go if that's your total objective. Mine, I'm a return to risk guy. I want to make as much money as I can for the minimal risk as possible.
Right.
And I am not, as I said the other day in an interview, if you dropped another $10,000 in my portfolio, I would just add it to the account and I would live in the same house as I live and drive the same 2019 Sorrento Kia that I love. And my life is all kind of planned out and I know where I'm going with my wife on vacation in the next 6 months and so on. Nothing changes.
Right.
So if my portfolio gets larger, it just gets larger. My positions get larger. I probably go to the 40 markets instead of 35 and I keep growing everything and adding maybe another strategy or two if we can handle it.
Yeah. So when you think about going back to the different markets that you participate in, how do you think about divvying up your strategies between the different markets? Do you find some markets get the same strategy, other markets get different strategies, or how do you think about splitting those?
I do it more on the basis of what time period and what kind of math I'm trying to put in place on a portfolio. And then I
Okay.
apply it uniformly to everything in the portfolio. Everything
Got
that
it.
I think has a shot at being liquid. I mean, before it gets into any portfolio, I like markets that are liquid and can handle the size that I'm going to throw at it. If it's I don't know, milk or something and it trades you know, 20 contracts a day and that's for 5 minutes of the day. Yeah, chances are that's not going to be in my portfolio. But if it's something like crude oil that's trading 24 hours a day practically, and can handle as much size as I want to throw at it, then that's a natural one that's going to be in the portfolio. Once I get the portfolio of liquid reasonably sized contracts or stocks or ETFs or whatever it is I'm trying to trade, I at that point would apply the math across the board.
Got it. Yeah. And to your point, it sounds like one of the things I really enjoy listening to the way that you structure your portfolio. It's built seemingly for robustness, right? You're coming up with something that works and it's not overly complicated. You're not overlaying it so that it becomes this really niche thing so that you can step away and fix your irrigation. Where a lot of other people, they might not have that structure. If it starts getting too complicated and your volatility adjusting everything, it seems traders start going down that rabbit hole sooner or later where they really start trying to overfit and over modulate every single component.
Yeah, I'm not a fan. I keep the parameter sets very low, and I try to keep the robustness up as high as possible so that basically any major run uh, that has happened in the last 3, 4 years, I'm in on
Right.
without a doubt.
Yeah.
Uh,
One of the
so
one of the other questions I wanted to ask you specifically about the RSI stochastic that you like to use, how do you avoid things like whipsaw in oscillators in general?
I use a timing indicator, a trend following indicator to trigger it. I
Okay.
don't I don't go in on the overbought, oversold. I just go in. I look at, okay, the condition's overbought, so I need to think about going short. So where is my short going to come in? I put a stop in, and when it executes, it's starting to relieve itself from that
I see.
overbought condition. And I will not go in until the trend following model goes over. So
I see.
I miss out on a little bit of the overbought condition. If you're really doing true mean reversion, then you're now you got a lot of trouble with you're overbought, but you stay overbought and you stay overbought and you keep shorting and stopping out, and then you're still overbought, and eventually you'll be right, and you'll end up making even more money than say a counter trend would. A counter trend to me means you're using a trend following model, but sort of in a short-term direction against a long-term trend.
Got it.
And I prefer to do that. I'm not a mean reversion guy. It just makes me super uncomfortable.
Yeah, yeah. You have to have a very specific view of markets for that. I also, it's funny because I identify a lot with your concept. I call it like not trying to top tick or bottom tick is the way I think about it. I'm not trying to catch the very tippy top or the very, low bottom
Right.
because I find timing those pivots to be as difficult as it sounds. To get the day
Yeah.
right is real tricky. When you're
You,
using
you
your
almost you, you almost need to be sitting there all the time, and I don't want to be sitting there all the time.
right.
So yeah, I mean, trying to time that is really tricky.
Yeah, and even if you stare at it all day, there's a good chance you still get it wrong. So
Exactly.
yeah, not a great return on time in general, I would say. Now we have a few minutes left. When you're overlaying your trend following with your oscillators, how have you dialed in what you're using for your trend following so that it fits well with your oscillators?
Um, hmm. I don't know that I have. I'm just using the shorter term. I'm using a conditional indicator to say that it's overbought, oversold over 21 days. So that's just, I feel like if I can look at the last month of prices and this is stretched one way or the other, that's all I care about knowing. I don't
Got it.
need more than that. And then to time it, I am picking a time period that is so short compared to my long term that I know it will offset a lot of the drawdown risk of the long-term strategy. So it's all in the design. I'm not trying to match my short-term trend following trigger to the overbought, oversold condition, because to me it's two separate things. I'm just
Got it.
want to know that I'm stretched, and then I want a very short-term trigger. So it's all designed to give me what I want.
I see. Yeah, makes a ton of sense. And it fits together really well and it fits like the broader portfolio, like you're talking about with the way that the risk interacts with each piece. The last thing I wanted to ask you is looking out kind of rest of the year, long time frame. Nobody really knows what's going to happen, but I'm curious what your general sense is. What kind of things interest you going into the tail half of the year?
Well, I'm looking at adding the Nikkei futures to my portfolio, so that'll be number 36. And I'm trying to figure out if there's a way I can trade one of the Singapore markets that intrigues me. Uh,
Interesting.
and it says in the instructions that I have to be an institution. I'm not an institution. I'm trading an individual portfolio. So I don't know if I can even get the data for this market, but we're going to do some more research on that. Still working on SimTrader, so we're still trying to automate that last now 7th strategy that I run, that I still do by hand every day. It doesn't take a lot of time, but it could be 25 minutes on a good day, something like that. But I'd like to get it down to about 5 minutes and free up my time more. So that's being done, and just watch what's happening with the election and
Yeah,
go on a couple of trips. We've got a seminar coming up with Lawrence Bensdorp in October, and we're going to hold it in Malaga, Spain.
perfect. Love
And
that.
we've got lower cost structure over there, so it's less expensive. So for all those US people that have been interested in going to a seminar and didn't like the price tag of the Las Vegas one, this one's about $2,000 cheaper because of
And you
the
get a trip
cost
to
structure.
Spain.
And you get Malaga, Spain, which is right on the Mediterranean, tucked right behind Gibraltar. The weather there is like Scottsdale with the sea nearby. It is
Yeah.
gorgeous. I've been there once before, and Lawrence Bensdorp used to live there, so he
Oh,
fixed us
cool.
up a super nice hotel right on the sea. Dinner Friday night with sunset and a champagne toast, looking out over the sunset on the Mediterranean. Should be pretty spectacular.
Well, that's awesome. I'll definitely grab links for all of this stuff from you to throw in the notes below for everybody to grab a hold so that they can reach out to you if they're interested. And then obviously I'll throw a link to your Twitter/X account. We'll get the right one there for everybody so that they're on the correct one. But is there anywhere else that you want people to be aware of to go check you out beyond your website?
Yeah, the website is probably the collection of everything Tom Basso. There's that contains just about everything in my career, a lot of research papers I've written, lots of thoughts on lots of topics. So
Yeah.
you can get that, all the interviews. As you get this interview packaged up, I'll try to add it to the interviews page. People can watch there. Yeah, it's a pretty extensive website these days. So
Perfect. Then I'll get everybody there because we have to get you down the valley because you have a birthday that we have to go get out there and celebrate. But thank you for celebrating some of it with us. We're absolutely stoked to chat with you. I always enjoy the opportunity to pick your brain a little bit and hopefully pull nuggets out for people to think about how it can apply to their own trading, because it's always awesome to be able to talk with seasoned folks like you. So thanks for hanging out.
yeah, well, my pleasure, Eric. It's always fun talking to you as well.
Awesome. Beautiful. Well, we'll catch everybody next time. Be an outlier. See y'all later.